But given what's happening in the market today, let's begin there. Okay,
Yeah.
Dow's down about 400 points.
Yeah,
It was down yesterday,
and it rebounded.
and it's all really about trade escalation, more tariffs coming on Friday. At least that's what the administration is saying. How do you see this whole thing playing out? Let's just start there.
Well, you mean the trade talks
Yeah.
and everything? I think that you've got an irresistible force meeting an immovable object, where both the Premier of China and the President of the United States want to come across that they prevailed and didn't give in. Which means to me that I think we're going to keep seeing more tension, and I think that the 25% tariff bump is better than 50% chance.
You do.
Yeah.
What are the markets going to do if we get to Friday and we do increase the tariffs?
Well, it's already happening, I think. The market obviously doesn't want increased tariffs, so it's been kind of reacting to that. But we have to remember that the market hasn't gone anywhere in 15 months. I mean, people keep acting like this is some sort of a locomotive that's chugging along. But the New York Stock Exchange Composite Index, which to me is the most important one because it's the biggest, it peaked in January of 2018, and then it couldn't quite make it back to that peak in October, and now it couldn't quite get back to the October level, and now it's rolling over again. So, you think about where we are now versus October, and just about everything is about where it was or lower. So I think this has been a process of trying to digest Fed policy pivots, which have created a lot of volatility, and then the fact that the global economy has slowed down in a very major way since the really peak period of late 17, early 18. So I think that's what's going on. One of the things that I'm looking at, and I put this up on the screen at the Ira Sohn fundraiser yesterday, was the one most concerning indicator is there's something called data change indicator by Citibank. And what they do is they just take the whole basket of economic data and they compare what's coming out now to their 12-month moving averages. And that had been at a very, very good level, both for the United States and globally, into the first part of 2018. And for both the global index and the US index, they've absolutely cratered nonstop. And the reason I bring that indicator up, because first of all, it's sending a signal, but beyond that, it's incredibly highly correlated with US GDP, the US data change index. In fact, it leads it, actually. And the divergence between GDP year over year and the indicator year over year, we haven't seen a divergence like this since 05 or 06. So a few months ago, I was saying that there are absolutely no indicators of recession on the horizon. And now we have some that don't suggest imminent problems, but they do suggest that it's not a lock at all, like it used to look like, that we're going to get to the presidential election without economic weakness and concern. And I think that that's pretty important, and I think that's why the market is struggling.
Okay. Let me play devil's advocate with you, okay? We had this big comeback in the market from December. Earnings are better than expected. China is better than expected. They've been stimulating the heck out of things there, and it appears to be working, at least on the surface.
Yes.
Europe isn't as bad as it was. I understand the German numbers were still weak. Earnings here were not of a recession variety. Granted, they were weaker, and they jumped over a very low bar. You've got growth here. You have no inflation. I hear the word Goldilocks being tossed around.
With all
Jeffrey.
that, the market hasn't gone up in 15 months. So that's, I think whenever you can tick off things that are backward looking and you tick them off as being favorable, that's priced in. Things that are known are priced in.
Better earnings aren't priced in.
Well, that's why we're back towards where we were in October, I think, is that rebound has to do with earnings being a little bit better, the economy improving in recent weeks until, I think, most recently. And obviously the Powell pivot was a really big deal for the market. And I think that it was the Powell disaster in December that caused the trapdoor market into December 26th, and the pivot was just so violent that basically got largely reversed. So I think that's what's going on.
So why should we go against the pivot now? If it's as powerful as you say, look, we just had a couple of down days in the market. Okay, we're down 400 today on the Dow.
Yeah,
feels bad. Yesterday we had a nice comeback. The overall environment of which you say happened in December still exists. The Fed pivoted.
Yeah.
There was a great pivot, and then they did a double down.
Yes. And there there's all in terms of market supporting rhetoric as they can possibly be, except for one thing. I guess they could take away that 2020 hike dot that they put in there, which to me was almost an embarrassment. I mean, you put in the 2020 hike, you have no idea. Look, we went from December to March with a complete different policy narrative. So how can you, with a straight face, talk about 2020 when you changed the dot so radically over just a several-week period? The 2020 dot is there so that the market can say, well, the Fed still thinks that things are okay for the long term, and they're going to be able to sneak in that other rate hike. What if they'd gone to we're never hiking again, which is precisely what the bond market has been saying for months. Bond market's been saying there won't be an interest rate hike for 5 years. I mean, the 2-year, 3-year, 5-year Treasury yields are exactly the same, which means that there's no chance of a Fed hike based on the bond market pricing for all that time period. So ask yourself, why is that? What is the bond market thinking about? And it must be that we're so late in the cycle, the data's weakening, and that interest rates, amazingly, have been tightened to a level that is causing economic concern. That's what the bond market's saying. And yet, at the same time, while all this happened, the spread between the 5-year U.S. Treasury and the 30-year U.S. Treasury, which hardly anyone pays attention to, but I look at it every day, has been steepening the whole time. When the stock market cratered, the 30-year Treasury bond yield widened to the 5-year. When the stock market roared back, the 30-year Treasury continued to steepen versus the 5-year. Why is that? And I think the reason is that people are starting to realize that and I hate to go back to this issue, but it's so fundamental, that the deficit and the national debt are totally out of control. Last year, 2018, the national debt, forget about the deficit, which isn't really the amount of true borrowing, the national debt increased by over 6% of GDP in 2018. Nominal GDP rose by 5.1. What that means, Judge, is that if we hadn't increased the national debt at all in 2018, GDP nominally would have been negative. And in fact, that's the truth for the last 3 years and the last 5 years, that the national debt growth is responsible for all of the growth in U.S. GDP. So if we're growing debt so much during a 5% nominal GDP period, and you ticked off some economic facts that are reasonably reassuring, what's going to happen when we turn down? And this is the focus that I've been thinking about, the thing that I've been focusing on for a long time. I mean, in the next recession, what's going to happen to the amount of debt, and is the Fed going to allow interest rates to rise at the long end, which is what's going to happen unless they go and emulate the ECB and the JGB. And that kind of, I'm getting a little bit ahead, but that's kind of what was underneath my recommendation itself.
It's not only the national debt that seems to be concerning to some. There's an article today that some on the Fed are worried about the high levels of corporate debt. Chamath Palihapitiya, Social Capital. I visited with him out in San Francisco earlier this week. Yes. You guys have had your thing on Facebook in the past, but that notwithstanding,
I'm not aware of that, but okay. I don't. Oh, he's a Facebook guy.
Yeah.
Oh, I see. Well, it's Facebook is well off its highs.
That notwithstanding, the issue of high levels of corporate debt.
Absolutely. That's been something I've been talking about as well. The corporate bond market was not really a problem in the Great Recession. It got dragged down due to all the economic mess that we were in. But the setup of the corporate bond market is so much worse today than it was in 2006. First of all, it's about triple the size. The triple B market is bigger than the junk bond market. And there was this report by Morgan Stanley Research, which really is worth taking a look at, that says that if you use leverage ratios alone, and there's other variables that rating agencies use, but it seems to me leverage ratio is a really important one when it comes to creditworthiness. If you use leverage ratios alone, fully 45%, not just of the triple Bs, of the entire investment-grade corporate bond market, most of them are probably triple Bs, but some of the even higher-rated ones would be junk right now. Right now. Think about that. You've got an $8 trillion corporate bond market, and that means that the amount of downgrades into junk from investment grade, if those statistics stay unchanged, would be bigger than the amount of downgrades in the subprime market.
So what's the spark then?
It's a recession.
So concerning, what's the spark? That's it, a recession.
Yes, a downturn. The economy is in such bad shape to withstand a downturn.